I'm going to be a little bit unorthodox here, and I'm going to let my panelists present themselves, introduce themselves, and then if they are too humble to share some great achievements, I'll chip in and add to it. So Chip, why don't you start?
I think we're all that stands in between everybody and dinner, so this is going to be a tough panel. But anyways, Chip Hazard, I am a co-founder of Flybridge Capital Partners, a seed and Series A stage technology investor here in Boston and New York. I also started another fund called X Factor Ventures, which is focused on backing companies with female founders. Prior to doing both of those two things, I was a partner at Greylock, and I joined Greylock right out of business school. I did come to this fine institution in 1994, and prior to that, I was in California, where we share a alma mater. So that's my quick background. I'm also an EIR here at HBS, so if you ever want to chat offline, happy to do that through that program.
Great, thank you. Kavita?
Hi guys, my name is Kavita Gupta. I lead Consensys Ventures, which was established 6 months back as the first VC hedge fund. We invest both in equity and tokens. It's a pre-seed, seed stage fund. We have officially announced 4 investments, have pretty much closed around 10 of them, and we are now expanding. We do invest globally, but we are physically expanding into Asia and Europe now. Cambridge has been very close. I went to MIT for my undergrad and actually came to this institute and dropped out from my MBA. But I think I pretty much ended up pretty fine, so.
Hi, my name is Walter Delph. I'm a partner at BCG Digital Ventures. My background has been serving as an entrepreneur for the last 20 years in digital. Had kind of some successes and some failures. Currently, we built a company called BCG Digital Ventures, which is part of Boston Consulting Group, and we're both a venture capital group and an incubator. We're 4 years old, and we've made about 50 investments so far. I think the difference between us and a traditional venture firm is that we both invest and invent new businesses, and we do it very similar to what the GE model was, which is we align with corporates, and that's kind of our unique platform. And so we've grown to about 650 people and 2 funds right now, a $360 million fund and a $75 million early stage fund.
Thank you. And I should add about Kavita. She's actually a recipient of a UN Social Finance Innovator Award in 2015 for being an integral part of the founding of Green Bond and Carbon Swap team at the World Bank. So congratulations, and thanks to all of them for being here. I'm going to have a few questions for our panelists, and then I'm going to open it up for questions from the audience. We've been restraining you from asking too many questions. You'll have the chance now. Let's just jump right into the questions. Today's high valuations make actually investing decisions extremely difficult. Because I was at Stanford, actually recent research there goes as far as saying that unicorns might report values that are on average 50% above what they are really worth. So how do you sort through these opportunities? What key metrics, key assets do you look for when investing? Chip, would you like to start?
So for us, I've been now doing the early stage venture capital thing for 24 years. And the funny part is that the earliest of early stage valuations actually haven't changed that much. So very first investment I was part of when I was at Greylock was, a 5-10 person company raising $2 or $3 million in single digit valuations. Our last investment at Flybridge, very similar, over 25 years. So early stage valuations haven't changed that much. What has changed, obviously, is companies that have momentum are able to translate that momentum into increasingly higher valuations. And so the subsequent rounds to seeds and Series A's are quite highly valued. But on the other hand, that's always been the case. And so the great companies are always, quote unquote, overpriced until you look back at them 2 or 3 years later and you say, wait a minute, that was a bargain. And so a company I was on the board of went public earlier this year. Every single round for that company was overpriced. Every single round has seen a good rate of return. And so there's something about growth that obviously leads people to not quite factor in what it can mean to grow at 50+% for many, many years and the value that can be created as a result of that. But it's hard from an investor side. It's like if you overpay for everything, you're going to have a terrible portfolio. So the key is like which company is worth overpaying for, and that gets to the quality of the team, the quality of the market opportunity, evidence of operating leverage in the business, differentiated technology, a whole bunch of things that you think about. But it's trying to figure out, as a venture capitalist, you're trying to figure out when to overpay, because you almost always are, by definition, overpaying on traditional metrics.
I think it's very different for the market which we are investing in. Because
It's all overpriced.
I would say it's speculative. So we have people coming, launching tokens on white papers and going with $25 to $30 million market cap and actually raising that within 2 hours of their launch. Is that the valuation of a white paper, or is that a valuation of 3 people whom most of the people who are investing actually have never met? Not really sure about it. And then when we do equity, it's the same thing. Even whatever the valuation you come up with equity, these entrepreneurs always has the choice to actually go and launch tokens on top of it, and then take the same valuation from, if it's a $5 million, $10 million equity round we want to do, then directly jump to 30 to 35. So for us, it's a very different way of valuing those companies. Are they overpriced? Yes, they are pretty much overpriced, but there are no subsequent rounds then. So once you are done, once you are in the market, you have done your seed, that's pretty much what you have raised, and the next block of money is going to come with the liquidity of those tokens or the utilizations of those tokens. So knowing that, if you are raising $30 million for next 2.5 years till you actually have a big market value of that company or the product, then that makes sense. Then that's actually undervalued with that respect.
Yeah, I definitely can't speak to valuations on blockchain, but I can say the answer you normally hear on this one is about the team and the founding mentality, especially in the early stage. And that's absolutely something that's important. But I think for what we do, which is also a little different than traditional venture, is we really look at the company's right to win. And so that right to win can be that they've had previous exits in the past before. It could be that they have kind of a unique partnership model in place or unique technology. But it's that right to win that I think is really the most valuable thing, because it's pretty difficult to keep your edge, keep your momentum globally now. So identifying that and recognizing if that team can continue to keep that right to win as a key metric.
Great, thank you. Both ride-sharing and home-sharing platforms are currently facing tougher regulation than when they first entered. So I wonder, how do you incorporate regulatory uncertainty in your decisions? And for blockchain, could the token economy be a new solution for certain regulatory and tax issues that we previously solved with just government regulation? Kavita, would you like to start?
I think first, tokens has to be approved as a solution before it becomes a solution for the regulatory body. It's in a gray zone right now. I think the recent subpoenas which has come from SECs on the usage of tokens, or whether it's utility or security, there's a lot of things which needs to be cleaned up for tokens to be a valid, lawful solution for raising money or being an asset class on the balance sheet. But I do think that the ethos of it started from how to raise money in a more democratized world without actually making a rounds of a very niche group of people and raising funds from there. So I do believe that that ethos is very strong and should succeed. And you are pretty much giving a part of your equity and the part of your company even when you're launching tokens. I think the accountability from the founders on the project, the transparency of milestones, and what do people really own when it comes to moving those tokens in the market and knowing all the risks before investing in it, those are the things which has to be clarified. But once a regulatory body figures that out, I do think that tokens are going to be a very big solution as a new funding need.
And I think one of the aspects from an investment perspective of what you're looking for when you're investing in a platform company is you're obviously looking for evidence of significant network effects. And so those can come from, more users create a better product that leads to more users, or more data creates better algorithms that leads to a better product. And things that feed on themselves recursively in a very positive way end up being truly, revolutionary, very valuable and exciting businesses. If you take that position and then you start to abuse that position, to either looking at your data in unique ways and doing some of the things that Uber's done in terms of how they've been trying to deal with regulators with spoofing their data or fooling their data, you're abusing your position. And so one of the keys to building effective platform business is making sure that you take advantage of all the network effects, but you don't push it too far. And that's obviously the fine line, and it's hard to walk that fine line. I 100% agree with you. I think one of the potential really revolutionary opportunities in the crypto token world is that the users are creating the incentives for themselves and they're benefiting from it in addition to getting the benefit of whatever the platform is. And so those should be inherently more fair and potentially not as prone to abuse because they're much more open, much more decentralized, much less likely to be controlled. So I think that's a promise that we potentially have the opportunity to take advantage of. And for the companies that aren't in that world, it's just making sure you don't abuse the position of power that you found yourself in.
Yeah, I mean, this is going to be a boring panel if we keep agreeing with each other in every comment. But I think blockchain is a unique opportunity because of cutting out that middleman in most of the equation. But a lot of the companies, when they start, they're not thinking and sweating the regulators. They're thinking about what pain points exist for customers or in the industrial model where there's problem sets that exist that can be solved in a more efficient way. So the regulators are going to be years behind just by definition. And so it's not something you should really keep awake up at night. I mean, yes, you can all of a sudden be out of business pretty quickly if the regulations go against you. But you can run out of money the next day running a startup company. So I don't think they're really sweating it too much. They're just trying to get to the next financing round or getting the next customer. It's kind of flippant what I'm saying, but I don't think Travis was really keeping up at night when he's going to local markets at Uber.
Thanks. One last question before turning it to the audience. How do you think about exits, and in particular sort of IPOs or going public versus acquisitions from corporate entities?
Yeah, we think about it the following way, which is in the traditional model, you have, in general, you could get bought by another company or you can go public. Those are two of the most positive outcomes besides going under. We look at the new ways in a corporate environment to look at exits to not just an exit into a corporation as an acquisition, but potentially through joint ventures. It's one opportunity that we've really pushed forth, which is multiple joint ventures in the marketplace, leveraging the platform. So it's not just one person and one person's data that makes up that whole platform, but multiple players. Then we also look at ways of acqui-hiring and adding on to these different ventures. And then you obviously have the IPO or a trade sale back into the company. But you're seeing a lot of different opportunities. Tokenization, that's a new exit that has just kind of emerged recently, or I don't want to speak out of turn, but seems to me quite recently. So exits have loosened up a little bit, but I still think while you've got this hyper valuation is that there's a lot of capital sitting on the sideline and that the IPO market hasn't been as open as it has historically. So you're going to see a lot of the VC money go really aggressive in the later stage financing because those are the few deemed like kind of successful companies and the market is valuing them accordingly.
I think for us, we start with an ICO. So most of the companies go pretty much public, and then they come back with any other option on the table. Now, if ICO/IPO is already out, then acquisition is the only option for the next stage, which we haven't seen anything in this space. And how the acquisition is going to work out would be something very interesting to see how the token economics of an individual company going to roll up to a bigger aggregator is something would be very interesting for us also to watch. But agreeing to your point, and I'm so sorry I'm making it boring again, is that how when we, in last 6 months, the trend which we are seeing is like established companies from last 20 years, 30 years, 10 years, coming and tokenizing either an individual product line, service line, or a whole company as a separate entity, as a joint ventures, and then raising a different set of capital based on that. And well, I don't want to go into the questions whether those tokens really make sense with respect to utility or not, but this has definitely become a new ground of capital for already, for the companies who are, if not exactly public, but one step beyond IPOs. There is another company in India who actually has already gone public 40 years back, and just for one very big telecom product are now tokenizing their whole product and raising capital per product. So it would be also interesting for us to watch how legal and rules and authority works on that, that if you're going to take a public company and raise another set of capital, where on books is that capital going to go? So it's a new world, dynamic, shifting world. We are still figuring it out.
Do you think a company that's done an ICO, an early stage company that's done an ICO, is acquirable?
I think so, and I think there should be a very interesting model to acquire those companies, because at the end of the day, you can use their tokens and the circulation of tokens, create their valuation based on the market versus the equity value of where the revenues are coming, and then loop it up in a bigger project. Now, how's that flow going to happen is something I wish I could be a part of one of first of those and figure it out.
If you do, let me know. I think just brief commentary, everything they've said is right, so this is boring, but the nature of the IPO market, it does actually still exist. It's just the rules of it have changed. And so when I first got in the venture business, the firm I was with, I think in the year or two when I started, we had something like 10 IPOs. But these were companies that were raising like $25, $30 million at $250 million valuations. They were just doing it in the public markets. That market doesn't exist anymore. That's now a private financing. That's a Series C. And so young, high growth companies are still able to finance their way to relatively high valuations and relatively large businesses. It just takes longer in the realm of being private. And so the company I'm on a board of that went public last year, we were 8 years in, but we're close to 200 million in revenue. We've got a couple $2 billion market cap. We were able to do a reasonable IPO, and now we need to obviously live up to expectations in the public markets. But those markets exist. It's just it requires patience, and it puts a lens on the size of the opportunity that you're going after as an investor, and an early stage investor, is that you truly need to believe you're in markets that can support many hundreds of millions of dollars of revenue. It's not tens of millions of dollars of revenue, it's hundreds of millions of dollars of revenues, and that's just it's a lens that we need to make sure from a decision-making perspective we incorporate into our thought process as we get involved with young companies.
Great, thank you. Let's open it up to questions from the audience.
Hi, so thank you for coming today, and thanks for taking my question. So I have two quick questions, real quick. So I own a virtual reality company. We do virtual education spaces. We've got monthly recurring revenue and some pretty unique partnerships. Question one is, would you be willing to see my pitch deck?
Absolutely, set it on. Chip at flybridge.com.
Sounds good, sounds good.
So we don't have to come to this room, we can just sit in with our Oculus on and we'll go to school?
Yeah.
All right.
Absolutely.
Let's let it rip.
If the data is on Ethereum blockchain, you can send us too.
Yeah, walter.delph@bcgtv.
Appreciate that. Thank you. Thank you. So you mentioned quality of team. We hear that a lot. Can you just explain what you mean when you say quality of team?
Yeah, so we spent a lot of time thinking about the characteristics, and it's really not so much resume and prior work experience. I mean, those things you pay attention to, but actually it's really not predictive of success. It's persistence and willingness to sort of ride the roller coaster that's inevitable in starting a company. It's the ability to hire and identify talent. It's being self-aware in terms of knowing your own skills and where are your gaps and being out how to fill in those gaps. And so we spent a lot of time on these sort of interpersonal characteristics that indicate leadership and grit and willingness to accept and build complementary teams. And those are the characteristics that we're ultimately looking for when we say, this is the kind of team that we want to be involved with.
Okay. Great, thank you.
I think when you're doing a pre-seed, seed stage investment, at least in my experience, you really don't get that much time to think through with the entrepreneurs, all the things which you said, because you don't spend like an year or 6 months or see them in action. If they get a problem, how they're gonna solve it, or seen them been through it. I think the conversations and the deep conversations around and bouncing out ideas, a lot of them, at least has in the past given us a very deep idea whether this person is ready to take something and accept that she or he doesn't know it, and then accept it, and then come back and then when they research it and come back and give us like a lot of researched ideas and their thought process with a certainty that this is the direction they take, that gives me a lot of confidence in the team or an individual that first that person has the courage to accept that he or she doesn't know everything, and secondly they can come back and actually have a solution out of it. So I think just to add on that.
Yeah, I mean, this is going to be short. Again, we're agreeing too much for my taste. I think it's a question of how effective they are, or he or she is at selling. And I don't care if you're normally a salesperson by trade or you're a technology person. You've got to be able to sell your vision to either fundraise or to hire people and to attract a management team and another team. So I think finding your unique voice, as an entrepreneur, don't try and be somebody else, but that passion that has caused you to found your business, and then make sure that you've tailored your message to a respective audience. It'd be very different if you pitched me versus Chip, versus the blockchain. So make sure you actually address your audience and find out what they're looking for as well.
Hi, thanks for coming. I just had a quick question. There's some speculation that ICOs are disruptive to the traditional venture capital. I guess would love to hear your opinion on the scale or scope if that's actually going to be disruptive to some of those businesses.
I feel like, so I think we just talked about this on the panel, right? It has already disrupted in the sense, if you're starting a company and on month 2 or month 3 of starting a company, you're sitting on $10 million to $30 million in your bank account, and probably in Ether, so it can raise up to $100 million if you just sit on this and not spend it, then that is a very disruptive model. Now, said that, I do feel like there is going to be a balance which is going to come in the market, and there's going to be more milestone-oriented fundraising within the ICO token launch world, which is going to happen. But overall, this is definitely an alternative stuff. It is, I usually call it glamorized and highlighted crowdsourcing, but in a way that which is way more attentive, or which has been way more technically intelligent, incentivized model in the blockchain space.
Yeah, this is obviously a biased perspective coming from the stage at which we invest, but there's a role that an early stage hands-on investor plays, which is helping a founder company build, and we think that role doesn't go away. And so what we are seeing is that we're getting involved with companies, typically equity investors, potentially equity that can convert into tokens at the earliest stage as a seed investor, like we always have. What's happening though, and we had, one of our companies did this a few months ago, if they go out and raise $45 million in ICO, they don't need to raise another lick of venture capital. So it's potentially hugely disruptive to the traditional later stage investors who have typically come in the B rounds and the C rounds and the D rounds of growth companies. And so I think that layer of the capital stack potentially for the subsegment of companies that an ICO is relevant for, it could be quite disruptive. And there's going to be a challenge though for management teams. When you have a publicly traded token, you're accountable to your community, which is great. That has a lot of benefits. You also run the risk of potentially being whipsawed by your community, and that you can't be as nimble and as agile as you'd like to be. So the timing of when you do an ICO is also going to be an important question that I think founders are going to have to wrestle with, because there's good news and bad news. You can look up how much your company's worth, and then it could also go down. At least when I checked this morning, it was all down 12%. You can get whipsawed every day and suddenly become short-term. And all the reasons why people stay private, you're now sort of a public 2-person startup, and that can be challenging. So there's some pros and cons.
Yeah, I mean, I think venture will be disrupted. I think it should be disrupted. It has been an underperforming asset class for a long time now, and Chip has been at some of the top tier firms, but if you start looking at the tier B and tier C firms, they don't really return their cost of back to their investors, and that's why there's a lot of first-time funds and they don't get their second fundraising. So I do think that starting the Series B, that you will see some disruption. I still think the big firms will remain. They provide a lot of value, not just in the early stage, but you see companies like Andreessen, who's kind of created a little bit of a hybrid model with a much heavier operational stack, which is helping to find talent on the engineering side, or technical side, or on the marketing side, or even actually in the regulation side. So you do see the model shifting a little bit, and I absolutely believe that the blockchain will affect it as well.
Hi, thanks for coming. So sorry to put you on the spot, but in the spirit of fostering disagreement, I really loved Hannah's talk earlier, and I think at the end she kind of mentioned that cryptocurrency was the main area where she saw blockchain really playing a role. Assuming you guys disagree with that, would love to kind of hear your thoughts. And then second piece of that, since a lot of these companies are becoming tokenized, how do you kind of separate the two in terms of thinking about it from an investing perspective, from the underlying business and what they're trying to do, and then the value of that token?
Yeah, I'll jump in quickly because I probably have as much to say here as you. We actually focus most of our time on the blockchain, not on the cryptocurrency side. And so what I mean there is that we're building back-end solution, front-end solutions by utilizing blockchain for supply chain. And we see that there's giant opportunities there to improve transactions through a supply chain that is often archaic in the way that it's being managed. And this is where we both invest and then invent, and this is where we have the opportunity to work alongside a company and actually put forth a blockchain supply chain type initiative. Now, on the ICO side, we're getting involved in that, but not as much as we do in terms of the investment on the actual building of different solutions.
Yeah. From the ventures perspective, we don't do crypto either. But said that, I do think blockchain has also got, in the earlier times, a lot of media hype because of crypto. Said that, I would like to say that crypto is a derivative of blockchain instead of the other way around. Yeah. Because if you see the usage of Ether, that is like a gas price on a blockchain technology. So I can still create a private blockchain or a permission-driven blockchain without having any crypto interference on it, if I'm sure there's not going to be an infinite loop coming and killing the whole computational power. But I don't think, as of today, I can do any ERC20 tokens or the cryptocurrency without having a system of the noding underlining it. On the second part about the valuation from the investment side, I think right now there is a lot of different models which are coming. Sometimes we only do equity, sometimes we only do tokens, sometimes we create a hybrid model of doing equity pegged with tokens and have both of them. The real test is going to come when these companies are going to hit mainnet. The applications are going to be there. The utilization of tokens creating the market and the supply-demand curve is going to be there. Then actually we're going to understand what is the real value between equity versus token and how much tokens intangible value is going to come on the company side and their value and going to drive the valuation. So I think we are still away anywhere between 8 months to 1.5 years to actually understand how is that balance sheet's going to look.
Yeah, interestingly, I actually agreed with a lot of what she said earlier. And so one of the first questions we ask ourselves when someone comes in with a blockchain-based project is like, could you use this just a regular distributed database? Because if the answer to that question is yes, you're inheriting a boatload of baggage by using the blockchain in today's world, because there's still tooling's relatively immature, scalability's a problem, transaction throughput's a problem. All those things are getting better, but why would you take on that baggage if you can just do it with a database? And so we start with that question, and then where the tokens come into play is you can start to maybe see these unique systems that you can jumpstart the network effects through a token, and you can get a community onto a project, and the project will get better because the community's on the project, and because the project gets better, the token gets more value, the community sees the benefit. And so if you can start to spin that wheel, as anyone knows who's started building any business that has any kind of network effects, getting that going is super hard. And a lot of projects don't get that flywheel rolling. And so if you can leverage a little bit of the speculation and a little bit of the mania in this space to create that flywheel, you potentially can maybe create a project that wouldn't otherwise exist. And so that's where it starts to get interesting. And so we're looking at both the unique aspects of the technology platform and the unique aspects of the community and how a token may play into that. And where you see those two, it's great. But the ratio of what we're seeing to what we decide is great is like way out of whack, because there's a lot of people jumping onto the bandwagon because it's an interesting bandwagon to be on.
I guess this is primarily for Walter, since you mentioned the joint venture. I'm curious what a successful joint venture with a startup looks like for a firm like yours. Do they tend to be for a specific market, with a strong vertical, or is it more for early stage for different applications? Do they approach with a use case or with specific productization already developed, or do you help with that process, or primarily with the business connection aspect?
No, we help on the business build aspect of it, so all the way from idea all the way to launching. And then to address your question, I think we talked about this on the panel, like name some failures and some successes. So this is kind of the prime opportunity to talk about how I screwed up sometimes. So one opportunity, we built a baby heart monitoring IoT device that we launched into China, focused on expectant moms and leveraging some macro trends like the listening to the One Child Policy Act. Our partner there was Allianz, and they're the largest insurance company in the world, and so we had all the capital that we needed for that. The problem that we had, which is with scaling that up and scaling that platform up, which was more than just getting the heartbeat, was actually leveraging Chinese consumers. And while we were able to significantly increase the customer acquisition for the business didn't take off. Now, we did learn our lessons when we launched another IoT device, this time out of Southeast Asia. And this time we had a much better handle on customers, and we were able to scale very quickly, in less than 12 months, to become one of the largest micro insurance providers in the country. But the answer is this business is hard, and we think that if we can leverage the right to win, the right corporate assets with the right managerial team and founding team, you can get an advantage startup. But we're still expecting a 1 in 3, 1 in 4 hit ratio, which is great, but it's still 2/3 of what we're going to do is going to fail.
One last question, and then I have also one last question for you.
So we talked a lot about blockchain, but I'm going to move us off blockchain because we're in Boston and you're talking about investing in platforms and digital initiative. What about healthcare?
Yeah, healthcare is an interesting space. I tell people that about every 3 years I lose my mind and I go back into healthcare investing. And this is from an IT perspective. So I do not participate in devices and diagnostics and therapeutics. So that's not an area of expertise. But the intersection of technology and healthcare is this great promise, because you've got $1 trillion that's spent and it's wildly inefficient, and boy, it looks like an opportunity for AI and automation and all these kind of things. And then every couple of years I do that, and every couple of years I'm like banging my head against the wall trying to sell into the health systems. So there's something about the healthcare sector in terms of how they adopt technology that needs to be rethought. And so it's a convoluted decision-making process. They don't adopt and streamline efficiency. You're obviously dealing with very mission-critical applications, and so there's a level of caution that comes along with that. And anytime you have caution and inertia, that's what kills startups. Startups work best in areas where they can benefit from the rapid cycle time and they can iterate faster than the next person. But if your customer's iterating every decade, it's going to be hard to win. So it's not to say there's not opportunities in the intersection of healthcare and technology. It's one that is potentially fraught with more danger than most because of the rate at which the customers change.
Yeah, that's funny that you what you said. So we one of the core areas, we focus in 4 areas, is healthcare. It's a big investment area for us, and obviously the market opportunity is trillions. And but I would harken back to the conversation earlier about the institutions, and healthcare institutions are painful to deal with. I am seeing some positive momentum on that side. I was asked to join the board of a big hospital group in California, Cedars-Sinai, and they've created a number of what I'd call kind of baby steps, but crucial baby steps in order to be more flexible. And you see other hospital groups doing this as well. So they have a partnership with Techstars, and they've had it for multiple years, which means they have a class of entrepreneurs, that are feeding early stage ideas into that company. They have obviously a pretty dynamic CEO who's embracing some of these changes and pushing those changes down into the organization. And then finally, they have an early stage funding capability as well. So they are invested in a startup company out here in Boston, actually. Those are small steps for a company as big as they are, but those are crucial steps to understanding how different the technology entrepreneurial world is than being a healthcare system in a regional environment. Now, I don't think that's happening everywhere in the United States, but you are seeing some huge institutions kind of making that first step, and that's a very positive thing.
I want to underline for blockchain world and healthcare. It's a very interesting observation that it is easy to go to emerging markets and create a new innovative healthcare solutions from the technology perspective than actually in the United States or in Europe. Because the insurance industry has created so many difficult layers for an individual to own their health data that Africa and India is way ahead. They are just completely on a different level when it comes to using an individual data and using it and connected it with government, hospitals, or public health services than what we can even touch in the United States today.
Great, thank you. And one last question. Some of the people in our audience are students. So any advice you have for people who want to join this ecosystem on the investment side or on the entrepreneurial side?
Yeah, I have my 15th year reunion this year, and I remember when I was at school, it was during one of the bad recessions in 01 through 03, and a lot of people I was friends with didn't have jobs when they graduated, which actually made our class better and tighter. And I think the advice I'd say is go out and understand an industry and actually get expertise in that industry. There's a lot of value to have a failure or two under your belt, and to be able to use that leverage to make those right investment decisions later in your career. That's just a pathway. I could see there's obviously countless ways you can take about your career, but I can't think of anything better than to actually go out there and get your hands dirty.
I would just say experiment. You have like 2 years of your life or 3 years of your life to do anything what you want. Do tons of internships, read a lot of stuff, meet people. And if nothing happens, you drop out, you sit here. So it's all good.
Great.
Let her rip. Yeah, cool. Get involved in, the amazing thing for MBAs, getting involved in a growth opportunity is ultimately what is really fascinating. To the question of what we look for in founders, I told this story the other day. One of my very, very first venture investment ever, we hired a young MBA out of Harvard as sort of a jack of all trades. And that company grew and went public and then ultimately sold to ADP. He's now the CEO of ADP, having joined a startup out of business school. And so, there's nothing like growth to create opportunities for MBAs. And so find a high growth company that's in a field you're passionate about, and you never know where it'll take you. So go for it.
Thank you so much, Walter, Kavita, and Chip for being here. And thank you to all the participants who attended.